This is the Daily Market Comment by Marios Hadjikyriacos and Maria Pachurdiz. Thanks for joining us at XM.com. It's time to talk about China. The situation is getting dicier as the nation's second largest property developer, Evergrande, is on the verge of default. Trading in the company's onshore bonds was suspended today, which is usually a prelude to bankruptcy. Its total liabilities boil down to around $300 billion, or 2% of China's GDP. Now, that doesn't sound dramatic, but it is when leverage comes into play. China's real estate sector accounts for nearly 1/3 of the entire economy, while the banking sector is currently almost 3 times as large as GDP, which means banks are levered up to the brim with private debt. So you have a vulnerable system with tremendous private debt and banking leverage, and now a company that was flagged by the Chinese central bank back in 2018 as posing systematic risks to the entire economy is about to default. Of course, Beijing won't let that happen. The private sector might be drowning in debt, but the government has plenty of dry powder and cards to play. It could stop any domino effect at its root by bailing out the most fragile players. But when you combine the fragility in the Chinese system with signs that economic momentum is already crumbling and the regulatory crusade that Beijing has embarked on, it's one risk too many. Policymakers might be able to stop a default cascade, but they can't revive growth without making the nation's leverage problem even worse. The fallout has been contained to stock markets in China and Hong Kong so far, but if the situation deteriorates any further, the next levy to break might be China-sensitive currencies like the Australian and New Zealand dollars. Over in America, Wall Street ended with broad gains on Wednesday without a clear catalyst. President Biden attempted to secure support yesterday for his transformative $3.5 trillion spending bill. This bill is a double-edged sword for the market, as with great social spending also comes a greater tax burden, most notably on corporations and capital gains. Elsewhere, oil prices remain in an upward trajectory, capitalizing on another drawdown in U.S. inventories and the aftermath of the recent hurricanes, alongside hopes that surging electricity prices across the world will ultimately generate a shift towards crude. As for today, all eyes will be on the latest edition of U.S. retail sales. Forecasts point to a second straight month of declines. A minor retreat wouldn't be a sign that the U.S. consumer is rolling over, but rather that things are normalizing. Finally, the Australian dollar is under pressure today after some disappointing jobs data. This was today's Daily Market Comment. Thanks for joining us at XM.com.